What is double tax agreement? Double taxation is a concept that affects individuals and businesses around the world, and it's essential to understand its implications. When you earn income, you expect to pay taxes on it. But what happens when you're taxed twice on the same income? It can lead to significant financial burdens and even affect your overall wealth. As Australia's trade and commerce become increasingly globalized, the taxation of international transactions gains greater significance. In response to the evolving patterns of living, working, and investing, tax systems have adapted to ensure that each country collects what it deems its fair share of tax revenue from income generated within its borders. Over time, different countries have approached this issue in various ways for a multitude of political, cultural, and historical reasons, leading to a diverse array of tax systems worldwide. Some countries impose taxes on citizens or residents based on their worldwide income, while others only tax income sourced within their jurisdiction. Additionally, some employ a combination of these methods. Due to these varying approaches and the growing mobility of people and capital, a notable and potentially significant problem of double taxation has emerged. A key function of a double tax agreement (DTA) between states is to eliminate this double taxation, which hinders cross-border trade in goods and services, as well as the movement of capital and individuals. Australia has established over 40 comprehensive DTAs with other countries, including nearly all of its major trading partners, to help prevent double taxation. The secondary goal of a DTA is to combat fiscal evasion, which can diminish a country's tax base when a taxpayer has economic ties to multiple nations. Recently, concerns have arisen that DTAs might facilitate double non-taxation or reduce taxation. These issues were addressed in the OECD G20 Base Erosion and Profit Shifting Project. The changing focus on the objectives of DTAs is reflected in the November 2017 revision of the OECD Model Tax Convention, which included new language in the preamble stating the intent, without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangements aimed at obtaining reliefs provided in this convention for the indirect benefit of residents of third countries. To give you a better understanding of how double taxation works in practice, let's look at a real-life example. Meet Anna, a freelance writer who splits her time between the US and Australia. She earns income from clients in both countries, but she's still a US citizen. In this scenario, Anna would be taxed on her income in both the US and Australia. However, thanks to the tax treaty between the two countries, she can claim a foreign tax credit in the US for the taxes she pays in Australia. This means that Anna won't pay double taxes on her income, but she still needs to file tax returns in both countries and navigate the complex rules surrounding foreign income. It's not an easy process, but it's essential to get it right to avoid any penalties or fines. Double taxation is a complex issue that affects individuals and businesses around the world. While it's not always possible to avoid double taxation, understanding how different countries handle taxation and the tax treaties in place can help you navigate this complex issue. Remember, it's essential to stay informed and seek professional advice to avoid any financial pitfalls. If you've had personal experiences with double taxation, I'd love to hear about them in the comments below. And if you're interested in learning more about tax-related topics, be sure to check out my other videos on the tax. Thanks for watching.